Hello everyone, welcome back. My name is Arias, and today we're going to be talking about everything that just came out last week about Invitae, including updated guidance, major leadership changes, and a lot of juicy details from their conference call. Don't forget to like and subscribe if you enjoy this type of content, and leave any video suggestions and feedback in the comments below. And without further ado, let's get into it. First, let's talk about their drastic changes in leadership. Kicking it off with a bang, Sean George, CEO for the last 5 years for Invitae, will be stepping down effective immediately. He will remain on the board and as an on-call consultant for the company. Fortunately for the company, this will not be the first leadership transition they will have to undergo, with Dr. George assuming the role of CEO in 2017 and Invitae having been founded 7 years prior in 2010. His successor will be Invitae's COO of 2 years, Dr. Kenneth Knight. Dr. Knight got his bachelor's in electrical engineering and got an MBA later on, but has been working in industry for many years. He appears to got his start working his way up the ladder at GM before a brief stop at Caterpillar, and then spent 4 years overseeing Amazon's transportation services, global delivery services, and global fulfillment and human resource operations. On first impression, he seems to be competent and is certainly going in guns a-blazing, and I will be excited to see the impact that he makes. The final major leadership change is co-founder and former CEO Randy Scott will return as chairman of the board. I think this is an underrated move, as keeping some of the vision that founders tend to have is important for long-term success. Overall, I'm happy that they've started to make some changes. However, I'm very disappointed that it had to come to this. I appreciated Sean as the CEO, as I feel like he had a positive vision for the company that they may have been able to execute on if the bull market had gone on just a bit longer. But it did not, and now they are forced to readjust and focus on how to put the company in the best position going forward. While those are some drastic changes going down in the leadership area, the updates to financial guidance are even more startling. First, they plan to make changes to save $326 million in annualized savings to be implemented by the end of 2023, the specifics of which we'll talk about on the slide after next. These actions will extend their runway until the end of 2024, from their previous guidance of having cash runway until the end of 2023. They announced preliminary cash burn of $150 million for the second quarter, which is a very respectable number, and would have put them on pace for being in the low range of their cash burn guidance for the year of $600 to $650 million. As of quarter end, they had $737 million remaining in cash and equivalents, and guided for burn of $225 to $275 million in 2023. They also maintained their 2022 cash burn guide, now inclusive of the majority of a $75 to $100 million to be used in restructuring. This 2023 projected burn rate was a positive surprise, as I was expecting somewhere around the $400 million, or at very least somewhere in the mid $300 million range. So far, everything was good news. Short-term burn reduction was solid, long-term burn reduction and resulting extension of cashway was excellent, but here's where it all started to go south. They announced preliminary Q2 revenue of $136 million. That was a miss and would make it very hard to hit their 40% year-over-year growth from last year to this year, as they had just $260 million in revenue for half a year, meaning they would require massive growth to hit the full year numbers. Unfortunately, it now goes from bad to worse, as they said revenue would be flat from the first half of the year to the second, resulting in low double-digit year-over-year growth. As if that wasn't disappointing enough, they termed 2023 an adjustment year for growth and expect revenue to remain flat from 2022 to 2023. But at least they expect to return to 30+% revenue growth once they're through the adjustment period, right? Unfortunately, again, no. They're guiding for just 15 to 25% revenue growth long term. While this is a pretty rough outlook for revenue over the next few quarters to years, one thing I did skip over was margins in the second quarter of somewhere between 39 and 40%. While you might say that that's not exceptional, and I'd agree, they also guided to have full year 2022 margins in the 42 to 43% range. This is while I estimated their blended gross margin for the first half of 2022 was around 38.2%, assuming they report actual revenue of $136 million in Q2 and actual gross margin of 39.5%. That means if they are to achieve full year 2022 margins in the 42 to 43% range, that they would need to have gross margins in the 45.8 to 47.8% range. I think this is an overlooked bright spot to look forward to and look out for in the balance of the year. Quickly, we'll go through their outlined plan changes to get to the $326 million in annual run rate savings. The biggest run rate savings will come from reductions in headcount and lab space. This portion is pretty self-explanatory and will save them an estimated $152 million every year over the Q1 2022 OPEX run rate. The next biggest savings bucket will consist of $84 million in savings via portfolio optimization. This refers to exiting non-core businesses or products that require large near-term investment or have an unclear or long pathway to positive cash flow. Next up is $67 million in savings by optimizing external professional services spend and reassessing other technological spend to eliminate inefficiencies. The final $23 million in estimated savings will come from narrowing their geographical footprint to around a dozen countries from over 100. This will greatly simplify their operations and logistics. I hope and trust that Invitae's management has done a cost-benefit analysis of letting these revenues go, especially in reducing the amount of geographies to make sure that it's worth the relatively small amount of savings for the amount of revenue they're giving up. Now, let's move on to their call. Now, for my notes on the conference call. First, management noted that they still see high margin growth in their genetic testing business, but that the transformative growth will come from their genome management business. For those of you who don't know, their genome management business will consist of Invitae managing companies who are doing research, buying access to patients' genetic information from Invitae, of course with the patient's permission to participate in a study. Invitae plans to increasingly turn this business into a lucrative two-sided marketplace with software-like margins. I too see Invitae's massive profit growth coming from this portion of their business rather than their testing avenue. Another interesting point is they said that 2024 burn will be the remainder of the leftover cash. By my math, that would be about $181 million, assuming they hit the midpoints of their guidance and burn $625 million in 2023 and $250 million in 2024. That would only be roughly a $70 million reduction from 2023 to 2024 after a $375 million reduction from 2022 to 2023, assuming they hit the midpoints of all their guidances. But that doesn't really seem right to me. Maybe they are cutting all of the fat and what expenses remain will be tough to get rid of, and that's why the reduction of burn is so much smaller from 23 to 24 than 22 to 23. However, I think this also might mean there's a chance that they are sandbagging these numbers. Let's say they can reduce the burn by $150 million after burning $250 million in 2023. That would leave them with burn of $100 million in 2024 and roughly $80 million left. They would have to raise some money to roll over the 2024 converts, an outstanding $100 million debt facility, and $80 million still may not be enough to run the business with, so they'll probably have to raise more than that. But with $80 million in cash for 2025, they might be able to survive to get profitable on that alone, assuming they can take care of the debts as well. Moving on, they reiterated they are obviously no longer chasing growth at all cost, and this started last year, but has continued into this year, and this is very clear with the most recent guidance. Something that I have found very important was the sense of urgency that they seem to have in dealing with the 2024 converts. They recognized that they were weighing on the stock and said that they would deal with them as soon as they can. This is a big point of interest for me, as these present the biggest risk for Invitae going forward. Moving on, when asked about M&A, Ken stated that they would be opportunistic and that they didn't have a predetermined M&A strategy. However, with how committed they are to reducing cash burn, a really good deal at a fair valuation that would meaningfully contribute to the bottom line in the short term would have to come around for them to be acquisitive, in my opinion. Next, they noted they are looking into selling the distributed cancer kits business due to difficult logistics and the fact that it doesn't provide more data that contributes to their long-term strategy. However, they did confirm that they will be keeping their LVT and PCM services, which, as you know, as you've watched my videos on Invitae, I think could play a big role in their future. It will be interesting to see if this can fetch a significant financial return for them, and that may help extend their runway further. This seems unlikely to me, as if it was a super attractive business, they wouldn't be selling it, and thus it will not likely fetch a large haul on the open market. They will also be exiting their IVF business. While Invitae does have their women's health business, I can't for the life of me understand why they were ever doing IVF. I know they want to be a one-stop shop, but that seems like something that is very non-specialized and someone else could do it, and if they wanted to be involved, they could just earn a referral fee. That being said, I'm glad they're exiting it, even if it will cost them some revenue. Speaking of exiting business, 15 to 18% of 22 revenues will not continue into 2023. Theoretically, this means that they would have had at least that much growth in 2023, if not for these reduction measures. Moving on, another point they made was they still have a relatively broad portfolio, despite cutting some of their non-key products. This will still be a major advantage of theirs when working to continue to increase sales by broadening their offering to previously specialized customers, especially when compared to other single product focused companies, which may have much more limited options. They also mentioned that they will still be working with PacBio. However, it sounded like the deal had been altered slightly to lessen the burden on Invitae, and while this result is unfortunate, it makes sense in the grand scheme of cost-cutting measures that they are taking. Dr. Knight also called out pharmacogenomics specifically as a business with an opportunity going forward. I see this as one of their most recently launched but highest potential businesses, and I'd expect excellent growth in the coming years. Management also said that they will maintain their long-term 50% gross margin goal, and there may be some interesting implications of this long-term. As their genome management business grows to be a larger part of the revenue mix, this will bring in more extremely high-margin revenue into the fold. As I said earlier, they could end the year at gross margins of 46% or more, and with only more focus to come in this area as they endeavor to positive cash flows. This means that Invitae may intend to divert much of the extra potential margin from their high-margin genome management services to lowering the cost of genetic testing and thus making them more accessible. However, that's not the name of the game right now, and they should remain focused on getting cash flow positive, but this could come into play down the line if they make it. On another encouraging note, management called out with a drastic decrease in the number of geographies that they will be providing services to. They expect to be able to increase the level of attention that they will be paying to each geography and improve their performance. They said that they have a list of actions that they plan to take with the freed up attention, and I'm excited to see this performance boost play out. Finally, from my notes from the call, and on a much more somber note, management did call out the risk of recession. A massive recession would sap demand and drag on Invitae's cost improvements due to lower volumes, and I think this would likely be the final nail in the coffin for Invitae if it comes to pass. Moving on, let's get into my conclusions from these recent announcements. I am worried about Invitae's future. Bankruptcy is starting to make up more and more of the potential outcomes. They are in a very precarious place, and even an above-average outcome in terms of business performance over the next few years may not be enough to get them to the other side. What is most worrying to me about this report is their revenue growth guidance. I understand if you cannot grow revenue while going through massive restructuring that requires you to cut a significant part of your revenue year over year and a significant portion of your staff. But what worries me is their guidance of 15 to 25% revenue growth after that restructuring. If this is the baseline for the rest of the decade, this lowers the potential high watermark outcome of the company drastically and shifts the risk-reward ratio out of my favor. Before, we were talking about crossing $1 billion in revenue within the next 2 years and the next billion coming soon after that. Now we're looking at 2027 for the first billion and the second billion coming in 2030 or beyond with those revenue growth numbers. Now, if I interpreted what they were saying correctly, these estimates were just until they hit positive free cash flow. However, I would really like confirmation of that. Is management sandbagging these numbers? I think so, as there will be a high demand for their services, as they are supremely valuable, and thus revenue will be largely based on their ability to scale. But of course, we'll have to wait and see there. Now, for the next slide and a half, let's broach the question of if and when they will get profitable. The main part of the guidance on cash burn that they released is that they will save $326 million over the Q1 OPEX runway. Their GAAP operating expenses were approximately $240 million in Q1. However, their non-GAAP operating expenses were $30 million less at $210 million. I assume that the announced reductions will be over the higher GAAP number of $240 million, which would put their yearly burn after the reduction at $634 million, but that's another variable to consider until we get confirmation of whether or not it was over the GAAP number or the non-GAAP number. These numbers improve significantly if the reduction is based off the non-GAAP number. With a $634 million burn rate, or a quarterly burn rate of $159 million, they would need $1.27 billion in revenue a year and a 50% gross margin to break even with this operating expense runway. As we just talked about with the low projected revenue growth figures going forward, they won't be clearing $1 billion in revenue until at least 2026 or 2027 by my math, long after they would have gone belly up without reaching profitability. This is all to say they need a reduction in operating expenses and or improved margins so they can reach profitability in 2024 or 2025. Now let's go through the thought exercise of what numbers Invitae needs to hit to be profitable. Before we start, I want to emphasize these are not projections and should not be relied upon for your decisions. It's just a thought exercise to illustrate a point about the company's financial position. We will start with a few assumptions. One is that they are projecting to burn the remainder of their cash in 2024, which would equal $181 million if they hit the midpoints of their guidances. Let's also say that their revenue was flat year over year to $510 million in 2023, and then grows 20% to $612 million in 2024. Let's also say that they have gross margins of 50%, which is their long-term target, which would yield a gross profit of $306 million in 2024. Going back, if they lose $181 million that year, that would mean their operating expenses were $487 million, because all of their gross profit and $181 million more was used up in operating their business. That would be a $147 million reduction from their guided run rate in 2023 of $634 million that we calculated on the last slide. Now remember that $147 million reduction in operating expenses from 2023 to 2024 that we just showed is very realistic, as they just have to hit all of the midpoints of all of their guidances to reach this and improve their gross margin roughly 4 points from the end of the year's run rate. In the second half of this example, let's say everything remains the same with flat revenue from 2022 to 23 at about $510 million and 20% growth from 23 to 24, but then let's add another 20% growth from 2024 to 2025. That would imply $734 million in 2025 revenue. With a 50% gross margin, $734 million in revenue would translate to $367 million in gross profit. That would require a $120 million reduction in OPEX for 2025 to be profitable, which is less than the $300 plus and $150 million reductions that they would have potentially put in place in the prior years. And of course, if either revenue or margins are better than guided, they would be more profitable sooner. So there is a very realistic path to profitability. However, there is still a gap for them getting from 2024 to 2025, in that with these metrics, they will run out of money in late 2024, unable to get to 2025, where they would be profitable. After reducing burn from $625 million in 2022 to $250 million in 2023, a reduction of $375 million, I think it's definitely possible that they reduce burn by more than $70 million from 23 to 24, which is what the guidance of lasting until the end of 2024 implies. Let's say they decrease the burn by just half of what they did from 2022 to 2023 and reduce the burn by $125 million. While they would still require some way of dealing with the converts, that would have them burning just $63 million in 2024 and go into 25 with about $100 million. All that said about getting to profitability, the 2024 converts and Archer DX debt facility are still outstanding and weighing on the company, and I will look for these to be resolved in addition to securing a bit of extra funding to regain my confidence. Finally, for my conclusions. Invitae is cutting this super close. More reductions are needed in OPEX past those that are announced to get them through, but these are doable in my opinion. What would not be coped with and would spell the end in my opinion is a massive downturn in the economy that kills their demand in the short term. Investors need to have this part of the economy go their way. If it does, the upside could still be huge. If they make it through, they still have potential in developing an excellent genome management business and still have very useful, desirable products in the oncology space on top of their regular genetic testing business. This is what I kept thinking about while making this video, is how this all comes back to what you think of their business. This is what I need to get back to when discussing Invitae. It is what I intend to do in the future videos on the company, rather than the further discussing the all too real financial peril the company is in. With all of that, I have paused my buying of Invitae until I can get some of my questions answered, even at these very attractive prices. This is a massive change, and especially if they do not calm some of my concerns over future revenue growth, I may cut my position at a massive loss in favor of companies which I think have better futures, because this revenue growth number is extremely influential on the value of my company going forward. Invitae still makes up 2.7% of my portfolio, with 13% ex-Tesla, with a 1031 cost basis, and has fallen from my second largest position all the way down to my sixth. Thanks for watching. What do you think of Invitae's new plans? Will they save the company? Let me know in the comments below. Thanks again for watching and have a great rest of your day.